joins must just sort of been where we're at. So thanks first of all for everybody for tuning in. I think it's always best when you discuss these things to hear it from the guy that actually designed these products for Investec. So I don't know who knows Japie and who don't, but I'll give a brief introduction. So Japie is a chartered accountant. He's also a chartered financial analyst. He's been around the block several times. He was worked for multiple corporates. He was the chief executive at the Eskom Pension Fund. He then went over to Katie's and then Investec basically poached him in 2000 to start a business for them. And that is basically what we're going to discuss today, is the structured product business that he has basically built. So I've asked Japie to give you an introduction as to how did he come up with the idea and where did it all start. So Japie, I would like to hand over for you just to give us a brief introduction before we start going through the material as to how did this whole structured product division come about?
Okay, thanks, Johann. I think maybe taking it even further back, I come from Zimbabwe. I come from farming background, and we experienced a lot of trauma when all the Zimbabwean farms were taken and everybody lost all their money. So that taught us a big lesson in life, and that is that we must diversify. It doesn't matter what industry we're in, you have to diversify, and you've got to diversify if you're living in Africa. There's some of your money outside of Africa. So that's a key principle. In my work experience, as Johann said, I was with Eskom, and I had quite a funny experience, in a way funny, but also so realistic. And that was that we had to send out 65,000 benefit statements. I'm talking now 25 years ago. So I can't answer questions about Eskom today, but like 25 years ago when I was the CEO there. And in the initial 2 years that we sent it, the stock exchange was doing very well. And I thought that some of these people would phone in to thank us because of the amount of money we'd made them, but not one phone call. And then in the third year that we sent it out, it was just slightly down. And I had to appoint 2 managers to take the phone calls. But about 100 people got through to me and said, I want to speak to the boss. So what's happened here? I said, what do you mean what's happened? They said, well, look, if I take this opening balance which you've given me, that's correct. I checked last year's closing balance. My contributions and Eskom's contributions are correct. But there seems a problem with the closing balance. So I said, what's wrong with the closing balance? They said, well, it's less than those other 3 numbers put together. So where's my return? So I said, look, you know that the markets are down, so this is a volatility of equities. So they would complain bitterly, and I'd say, so what do you want us to do? They say, well, we just want you to make us a lot of money, but don't lose our money. I said, at that stage, I had no solutions. So I said, okay, so you just want us to walk on water here. How are we going to do this? Anyway, I knew because I had 100 phone calls that I took that was the requirement. That was what people wanted. They wanted to make a lot of money, but they didn't want to lose their money. Okay, so hold on to that. Then I got poached from Eskom Pension Fund by Katie's brothers, also ex-Zimbabweans, who set up a derivative business in South Africa. And I was a director there and worked there for 3 years. And amongst other things, set up a private client business, much like Johann and Carly run here. And I had all the international unit trusts and share portfolios and the normal investments. And in 97, 98, there was a bull market. And we were making quite good money for the investors. But once again, my experience, people were always identifying another avenue where they could have put money, where they could have made more than where we'd put them. And then when the 99 crash came, they lost their money, as with the markets, like you've just seen recently with the virus, etc. And the investors were complaining bitterly. So I said, why are you complaining? They said, well, I've lost this money. And if I have to recoup it now with these low interest rates overseas, that's a huge loss. So I'd say to them, what do you want us to do? They say, I just want you to make a lot of money, but don't lose my money. You see the trend, same theme. So anyway, I go to Investec, and 20 years ago, we set up the business. And the objective in these offerings then is to identify the risk before we go into an investment. And as far as possible, and for this one we talk today in totality, take away the market risk, the risk that equities go down. because this part of the investment portfolio then can be compared to cash at a bank and a balanced fund, where I typically take less risk. On other components of the portfolio, the investor would typically buy direct shares or unit trusts, or have all the upside that comes from picking the right shares and the timing and all those other things. So Investec bought into the story. I don't know, Johann, if you've got that high level summary, maybe we'll just start with that. Just to give you
Just give me one sec.
An idea. So I started this business on my own, and we now have a 10 people team. Just go back a bit more. Yeah, okay, just go straight into the first page there, Johann. Okay, just stop there. So obviously any asset management business you manage, looking at how much money people have entrusted to you. We started with 0 in 2000, just a few ideas. We're now managing to about 22 billion rand. This is about half of the size of the South African hedge fund industry put together. All hedge funds in the country together manage twice as much money as we manage with 10 people. And this is obviously a net, so people that sold their assets, they would have left, and this is what's been retained. And then if we look at the distributors, so Johann is one of our distributors. We have 240 organizations in the world that market and sell the product. So obviously, all the financial advisors have to be correctly licensed and so on. And you can imagine they won't buy into a concept if it's not good for their clients. And that started in the far left in 2000 with only Investec. Now we have, extended distribution base. And then thirdly, if we look at the actual shareholders, people that have bought the shares. So in the first deal in 2002, we managed to convince 100 people. We now have 11,050 high net worth deals on the books, including roughly 40 of the country's billionaires. And of that base, I think about 8 to 10% is the Investec directors, staff, brothers, sisters, uncles in Israel, etc., etc., etc. Because we have a rule at the bank, we don't employ people who can't count. But then when they can count, they work out, how do I make a lot of money without losing my money? So this information here, we won't go into detail, but I will allude to it in the presentation. We'll use the one sheet.
I just want to highlight here, okay, so what we're going to discuss today is China Seas. And China Seas was initially launched in September 2010, okay, over a 5.5-year term. There were 267 investors. The currency was in Aussie dollars, and the total deal size was 47.4 million Australian dollars. And now, if I just roll over, you'll see then after that 5.5 years, March 2016, it basically opened up for new investors to come in, and existing investors had the choice to either sell out or remain in. And the new term was for a period of 4.3 years, roughly the same amount of investors, but you can see from a deal size perspective, went up from 47 to 70.9 million Australian dollars. What's important to note here is whoever invested in September 2010 and that are still invested in China Seas today has never paid 1 cent worth of tax. Due to the fact that you own the share in the company and the company makes the profit, not you. And because there is no corporate tax in Guernsey, the profits are not taxable. So those investors will only trigger a tax event the day they sell their shares. And the same applies for any new investors coming in today. So if you invest for a 15, 20-year time horizon, you will only trigger a tax event in 20 years' time, which is quite unique to this type of product.
Johann, just while you're on that page, just look at the last 5 deals here on the assets under management, the last 5 deals from Titans. Just on that page. Where you are there. Don't change the page. On Titans, look at under the total hard currency. Just to give you an idea of the size of these companies, that was 155 million Aussie dollars. That business is now worth 2.4 billion. These are huge companies. 110 million US dollars, 109 million US, 74 million US, 74 million US. So we're all talking companies here with a quantum of like 1.3 billion and bigger. So they're big businesses. And that to the shareholder, the person buying the shares in this offering, gives them the economies of scale. So what we're going to talk about now is a shareholder buying shares into such a big company. Okay. So maybe let's close
Before
this
we
one.
start, Japie, I just want to quickly position where does this fit into an investment portfolio.
Okay.
So let me just quickly run through 4 slides. I'm not going to be long. First things first is, I always tell clients, whenever you want to compare one investment to another, you have to look at these 4 components, and that is, what are the fees? How much risk am I taking relative to the potential return that I can get, and what are the tax implications? So we will basically unpack this investment, according to these 4 components. Then if I can just, many of you would have seen this before, but for those of you that are not PSG clients or not my clients as yet, just to position where does this fit into the PSG wealth investment philosophy. So we believe that one should have 3 investment strategies: an income strategy, a defensive strategy, and a growth strategy. The income strategy, you will know, does not have exposure to any equities because that can go up or down, and you never want to withdraw from something that can be down to go and buy a bread. So that's why we put money that you require for a year, in the next 3 years, we won't take any equity exposure with that money. And the inflation target here is to beat inflation by 1 or 2%. Then we have what we call a defensive strategy, where we add some equity and we add some property. At this stage, our property exposure is very close to 0, but theoretically one can add property here. And this is an equity exposure of between, let's say, 40 and 75%. So that's your typical balance fund will fit in here, your regulation 28 funds where your pension money goes into, etc., etc. And then we have what we refer to as your 7-year plus money that you do not need in the next 7 years. That is your wealth creation strategy. And here you'll see that we only invest in local and in foreign equity. So what we're discussing today is foreign equity, but taking credit risk on a local bank as far as credit counterparties are concerned. And Japie will unpack that for us in detail in a moment. Then also just important to understand the investment universe which one can invest in consists out of unit trust, listed shares, ETFs, and structured products. Now there's something like 1,500 unit trusts in South Africa, more than 250,000 unit trusts in the world that you can invest in. Listed shares, there's 50,000 shares globally that one can invest in, only about 400 in South Africa. ETFs, and that's exchange traded funds. For those of you that are not familiar with the term, there's 49 in South Africa and more than 2,000 globally that you can invest in. And what we're discussing today is a structured product that basically uses an ETF underlying, where the growth is going to come from. And importantly, we can buy this structured product in retirement annuities, in preservation funds, in living annuities, in endowments, offshore endowments. But ideally, if you're investing in your own name, you want to invest directly with the administrator, which is Praxis, because then there are 0 administration fees attached to it. If you have to use one of these investment vehicles, you pay an administration fee to the platform wherever you're on. Okay, that one we'll get to, and yeah, I think that's it from my side, Japie. So should I jump in with a Standard Bank?
Yeah, let's have a look at Standard Bank because we're going to be taking risk on Standard Bank. So I'd just like to start there, make sure we're comfortable why we're happy with Standard Bank.
Okay.
So maybe before I go into this detail, I just want to use one example to say, what is a structured product? How do I get exposure, compared to buying shares or the market itself? And just for the discussion, assume that Johann and I went and we were very keen on exotic game and we wanted to consider getting a farm and having exposure to exotic game because we thought the share price would appreciate, the exotic game price would appreciate. So if we went to a particular farm and we said to the farmer, can we buy your farm? And he said, yes, it's available. I had a sale, but that fell through. And I was going to get 10 million for this farm. So assume I said to Johann, you've got 5, I've got 5. Let's buy this farm. And we then debate the pros and cons, and it comes out that we're quite concerned because what if there's a drought? What if the exotic game prices plummet? What if they expropriate land with no compensation? What? 10 what's? All right. Then we say, but what if it all turns out nice? And Mr. Ramaphosa invites all the foreigners to come buy nice exotic wildlife farms here, and the world's fantastic. Then there's a whole lot of good stuff that can happen. So I say to you, I propose that what we do, as opposed to buying the actual farm, we ask the farmer to give us the right to buy the farm, a call option, the right to buy the farm. And for this discussion, let's assume he says, if you give me 20%, I'll give you the right to buy the farm for 3 years and 10 months. That's the length of this deal. If we give him 20%, he takes it, he pays off his bond, he carries on farming. We take the other 8, we had 10, we take 20, we give it to him for the right to buy the farm. And he gives us the right to buy the farm at the prevailing price, which is 10 million. We take the 8 million, which we didn't need to give him, and we put it with ABSA on a deposit. And at ABSA, assuming we're into a world like I'm going to take you to here, Guernsey, where there's no income tax, the 8 will grow to exactly 10 over the 3 years and 10 months. Take that as an assumption. So 3 years and 10 months, Johann and I walk in and we get a proper valuation of the farm. Let's assume the farm's gone to 3 million. Why? One of those things that went wrong. We say to the farmer, you know what, you keep your farm. We walk into ABSA, we take the 10 million, I give him his 5, I take my 5. We don't own the farm, worth 3. Conversely, it all went well. Everything turned out okay, the virus got sorted out in a few months, and everything is swell, and the farm's gone to 17 million. What do? We exercise the right to buy it. We have that contracted with him for the 10 million. We take the 10 from ABSA, we give it to him, we register the title deeds in our name. Now we're the proud owners of a farm worth 17 million. That's what we do, but in the world of shares. We don't want to own the farm if it becomes worth 3 million. Okay. We do want to own the farm if it becomes worth 17 million. And for that, we use a derivative being the option or the right to buy it. And we use debt. We use someone that we can place. In that case, the biggest thing that Johann and I would have to verify and check is that we'd have to be happy with ABSA. That when we go to ABSA in 3 years and 10 months, that our 10 million's in the bank account. It's the key risk we take. Okay? Because if we bought the farm, we'd have nothing to do with ABSA. That's principally what we're going to show you. Now, in this offering that we're going to talk about today, that entity that we're going to trust is Standard Bank. We're going to be using the debt issued by Standard Bank in dollars that's subordinate to the depositor. That means that in a balance sheet, the first person who loses money is your ordinary shareholder, followed by your preference shareholder, followed by, you can take that up, yeah, you can call that up, followed by your subordinate debt, and Johann's just ranked it here so you can have a look. The value of equity for Standard Bank, I assume this is for Standard Bank, Johann, is 165 billion.
As of this morning.
Yeah, 165 billion. And that's followed by preference shares. If they had preference shares, they probably have, but it's not on this schedule. And then subordinate debt, the box in red there. And that's followed by senior debt and depositors. This debt has to be issued by the banks as a percentage of their balance sheet, and it's regulated capital. It's ordinarily bought, the debt is ordinarily bought by Coronation and Allan Gray and PSG Wealth, their income funds. What we've done at Investec, we're going to buy that debt, we've already got it, and we'll stick it into this structure, which is the Guernsey company that will warehouse the debt. And I'll give you the quantums in a moment. But let's go back to Standard Bank.
I just quickly want to add something here, Japie. So in layman's terms, what we're basically saying, if things go wrong, before we will stand to lose money in China seas, all the ordinary shareholders of Standard Bank, which is currently a total of 161 billion, would have to write that complete ordinary share capital down to 0. Before the preference shareholders is going to take a haircut, they will write everything down to 0, and only then will the sub-debt holders be at risk of losing any capital.
Yeah, because your ordinary shareholder is the first person who loses. So let's go now to the Standard Bank schedule. Yeah. So what we did is we said, well, let's have a look. Who are those people that would lose then if they're going to lose first? And there's nice names called Allan Gray, Coronation, Prudential. You can see the names there. So they, in their general equity funds, have got Standard Bank for a total average weighting of 4%. You can see here where I've got the 4% average weighting of all of them together. Just come down to the average box here. And Standard Bank's only 2.39% of the top 40 index. So that's a very powerful indication that Standard Bank must be okay. Because why would they buy the shares in Standard Bank and take the first risk on if there was any issue with Standard Bank? But now, just to highlight how strong Standard Bank stands, we did an evaluation of the income statement, and I'm just going to focus exactly where your cursor is now. Standard Bank has a core tier 1 capital. That's the most powerful capital you need in a bank at 14% of their total risk-weighted assets. The minimum required by the Reserve Bank is 8.5. That excess that they've got is worth 60 billion rand. And Standard Bank on average makes 27 billion rand profit per annum. So if you say to me, what has to go wrong here before they don't meet the regular requirement, they'd have to write off 87 billion rand. What would happen at that stage? The bank would contact the shareholders. Who are the shareholders? The South African Public Savings, in the name of Coronation, Allan Gray, Ford, etc. So we're very comfortable to promote the use of Standard Bank because it's the second biggest bank in South Africa, and it really has got a strong balance sheet. But the investors must understand they're taking the risk to Standard Bank. So I think that unless there's questions, I'll move on from that. That we would also want to do only for a portion of your money, because you can't put all your money in any one bank. But Standard Bank's the one chosen here. Okay, so let's go to the presentation then, Johann. So China Seas, as Johann said, is a company. So just stop there on page 3. This company, as you saw there, has existed for a historic period. That's why it was called China Seas, because in the first phase, it was targeting Korea, Taiwan shares that are linked to China. Now it's going to be linked for this phase, which starts in the third week of July, to the ESG index, which we'll talk to in more detail. So this investment then is for 3 years and 10 months. Reason being that the Standard Bank debt that we're using has to be issued with a 5-year call date, at which stage Standard Bank calls the debt back. Now, this got issued already a year ago. And so by July, there'll only be 3 years and 10 months to go. You have a gearing on the upside of 110%, and that's conservative. I think it'll be more like 120, but we'll just talk to 110 as a minimum. That means uncapped upside to the performance of the index we're going to talk you through. You've got 100% capital protection in dollars, and you've got daily liquidity, daily price, and your minimum is $10,000. Let me give you the cash flow of the transaction. So on day one, the investors give us $100. That $100 could be $100 million for all intents and purposes, but it's 100 in total. We're going to take roughly 80% of it and buy these Standard Bank bonds. In dollars, those bonds will give us a return of about 6.1% per annum. So if you compound for 3 years and 10 months, 80 becomes 81, 82, 83, and matures at $100. That's how we can say to the client, we'll give you $100 back as long as Standard Bank debt pays as planned. Secondly, to give the upside, we're going to buy that call option. So what we've done is we've made arrangements with Goldman Sachs, and we're buying the upside to this index. But before we go there, what we put aside for fees, costs, expenses, because as Johann said, they're very important. That's the annual fees for distribution, which is to Johann's business. For us, for structuring, the administrators, all the fees, all the costs, all the expenses, I'll lump them together. That's plus minus 5 for the 3 years and 10 months. So we had 20, we put 5 in a bank account to cover those, and the 15 we've got left over will buy us the geared call option on the market. options are priced in massive quantities by all the banks. The pricing, unlike the farmer who would have had difficulty in determining whether it was worth 20% or 15 or 25, the banks have just got Black Scholes pricing models, and you can compare A to B on price. Much like if you want to buy car insurance, you can send a request to Outsurance and Santam and Legal in General, and they'll give you very similar price for the same request. Or life insurance, any insurance. Okay, so talking about this.
Japie, can I just add there on what's important to understand is, even though you're only using 15% of the 100 to buy the call option, is that you're buying it on the total 100. So you're not only getting on the 15% the upside of the call option, it's on the total 100 that you've put down.
Yeah, and if you take that back to the farm example, Johann and I put on 20% where we paid the premium to the farmer, but our profit and loss was calculated on the whole 10 million value of the farm. So the fact that the farm went to 17 million meant that 2 million of ours actually grew to 7. Just that component, because that was calibrated on the whole 10 million, and that's how the options all work. Now, page 4 just talks to a very unlikely event, and that's the event that Standard Bank doesn't call the bonds. The bonds have to legally be issued as a 10-year instrument, with the bank having the right to call it back after 5. The only time that the regulator, who's the Reserve Bank, will interfere with Standard Bank is if Standard Bank's under that threshold of the required capital of 8.5. Or something else that we can't think, why else would they interfere with the bank? They leave the bank alone. And Standard Bank will always want to call the bonds back because they can pay a depositor. If you thought of that credit, they could pay the next level up. They could only pay him 0.5% and get him to place a term deposit in dollars with them. So they're not keen to pay us 6 or 6.1. They have to, because they've got a gun to the head. They have to have a certain amount of that capital out there to protect the depositors. So you've got the protection that we spoke of there, of the earnings of Standard Bank and the reserves of Standard Bank and the deep pockets of those financial institutions. So this is very unlikely, but if they don't call it, all that happens is that we pay out the 20% that grew from 80 to 100 or 81 to 100. That we pay out as a special return of capital after 3 years and 10 months. We pay out the profit on the option, whatever the equities did times 1.1 at least, or maybe 120. And then we pay the shareholder annual fee until it is called, of which that can be the maximum is 5 years. Extremely unlikely, but at today's interest rates, that would be about 4.4% per annum in dollars until Standard Bank calls the bonds back. Okay, so let's move on because that's just theoretical. So what does this deal give me as an investor? I go in with 100. Assume the stock exchange crashes to 50. Then the debt is still 100. I get the 100 from the debt. I get nothing from the call option because it's what we say is worthless. And the fees and costs have amortized down to naught, so I get my $100 back. My next door neighbor, who didn't make this podcast, he put his 100 into the equities. And his advisor's telling him he's worth 50 because they went down 50. And that's hard, because now it's got to double to go back to 100. This investor just presses that right top button, undo, reset knoppy on their spreadsheet, and they've got the 100 in their bank account. And they can buy the market the next day at 50. Same as Johann and I in the farm example. If the farms went down to 3 million, we go to ABSA, we fetch 10. We go buy 3 farms and have 100 and have $1 million spare cash for lunch. Because 3 times 3 million, which they're available at now. So by buying in this way, you're avoiding the problem if there's a problem. And because we say that because it's so difficult to know when there will be a problem. If I'd asked all of you a year ago whether you thought this virus, and I explained how it would work, would have happened, you would have told me no ways. 1 in 100 chance that thing's going to happen the way you say. We don't know when the black swan comes. She comes like the thief at night. Okay. So that's why your friend Buffett will tell you, rule number 1 is protect your capital. And then rule number 2 is before you go forward, recheck rule number 1. Okay. So if the market is in our favor and it does 40%, then we times that by 1.1 in this example, and we get 44 plus the 100 is 144. So in the world of options, unlike the farm we could only make 1-for-1 profit. Here we make an accentuated profit because we're able to buy more with the premium. On the graph, payoff graph, you can see there, that's the end of term picture. If it goes bad, then you get your $100 back. And that's net of fees and costs, because as we explained, the 5% of the fees, costs, and expenses were built into the price. So, Johann, you'll have heard me say this before. It's like the milk in your coffee. It's not like the cremora on top. It's inside. Okay. And that's very important because the total expense ratio now is very low because it was part of the 100 that I had. So very, very good on the expense side. So let's move forward. So what is this index? So the index is the Environmental World Index. As far as performance is concerned, it started in 2004, this index. Just calibrating here on performance, you can see historically the S&P would have been the yellow, which would have been a higher return than this index. And the FTSE and the Eurostoxx would have been lower. And the green is the ESG index. Flows into the ESG have become very popular. I'm sure you've read a lot about environment and social and governance. And that's what this index is comprised. If we go to the next page, I'll show you how it works. Page 7 just depicts, how does this index get made up. So we've got these guys, CDP, they're a non-profit organization that do carbon footprint measurement and, all the stuff we don't want, plastic in the sea and the like. We have to look after the world. If we don't, you've seen just what eating a few wrong animals can do in China. Okay, it's not a pretty picture. And the fact is here, what they do is they take the top 200 shares in Europe and the UK, the top 200 by market capitalization in the US and in Canada, and they pick the 40 best by the, carbon, water, and plastic and, all the stuff that they measure. And they're experts on that. They're non-profit and they're independent. Those 40 shares are then run by Euronext. Euronext is the index provider. They equally weight them. So if you look here, the composition is equally weighted, the 40 shares, and rebalanced every quarter. And then at the end of the year, they reconstitute them. They take some out and put some new ones in. What's different about this index, because it's used mostly for options, and recognizing that the option trader takes a risk between what he assumed the dividends will be and what the dividends actually are. And hence, he charges a lot of margin and has to keep a lot of capital against that. So what this index has done is acknowledge that it's better to let him assume a 5% dividend, but he gives the index, adds the actual dividends received. And I can tell you that in history, that's had a slight drag factor on a comparative return, let's say like on the MSCI World, where you wouldn't have had that calculation. We're not too put off by that because I could have had a deviation from an index from any alpha fund or anything where I try and pick stocks. It never performs exactly like the index. But what do I want? I want shares in general, the asset class, equity. Okay, let's move forward, Johann. That is just showing what we've just discussed. I think let's page on from that. Just looking at the actual shares in the portfolio, if you take a moment there, you'll recognize 95% of these companies. They're huge, big companies.
Actually, Annalay actually did a summary for us, Japie, just to put it in perspective. So here is the 40 companies. And, obviously not all of them are listed in dollars because half is listed in Europe. But we've just converted it to dollars to convert it back to rands, just to get a feel as to how big are these 40 companies combined. And we get to a figure of 91 trillion rand, which is about 9 or 10 times bigger than the top 40 companies in South Africa. So just as a matter of interest.
It's amazing. So we're talking top companies in the world here. We did get, I think I've sent it to you on, you can forward it on to the guys, that Credit Suisse report where they did an analysis of ESG. And it basically shows over all the ESG providers, ESG as a way of investing hasn't actually proven to add value or subtract value from just picking the index. This portfolio is in any event 83% correlated to the MSCI World. And you can see here 80% of these stocks are included in the S&P 500 and the Eurostoxx 50. 80% of those names. They are the big shares. And the reality is that if you go to what sectors make them up, you might ask the question after the comment, why, if they're the same as just the index, why use it? Well, a lot of people want to do something for their grandchildren, and making sure that you keep these companies accountable and that they stop the carbon, high carbon burn factor that warms the world and kills the glaciers and does all types of bad for the world, and throw plastic in the sea and do all the things that destroy the earth. If it doesn't cost you from an investor's perspective and you can do good in life, we feel it's good to do good. That's why we use it. It's not to the detriment of our investment returns. If you go forward then, looking, Johann, at the next page, which shows you the sector allocations, that's just those stocks made up into what sectors: technology, banks, etc. And then the United States and Canada, when they rebalance annually, will always be 50%. So it's a world portfolio. If we go forward, as to how the performance of that index has been, and that index is after taking into account then the actual addition of dividends and subtraction of the decrement, that 5%, you can see that shape of that is very similar to 2 pages forward. Johann, go to MSCI World, there's 2 pages forward on page 13, so stop there. To the far right here, you can see, just look at the far right, the shape is exactly the same. It will be slightly different, but in essence, it's the same thing. And what you want to avoid as an investor is, just hold it there, is you buy something and it's at 1,600 to the far right, and then it smashes to 1,050. That's not nice. That's what you want to avoid. That's what the structured product helps you do. Because we say no one could have foreseen that. And expecting the fund manager to sell out the day before that is a hard ask. Or when it's falling, but it's like trying to catch a falling knife. Okay. So taking that index then, we've said if I'd had it historically over 3 years and 10 months from the inception in 2005, firstly to the left-hand side here, you can see after 3 years and 10 months, investors would have been in the red. They would have lost capital if you bought through that 2008-9 crash. Obviously, these investors, if they had this investment, would have got their 100 back. Just simulating the past. In good times, they would have had the green line, the normal investors. Here, they would have had 10% more. That's why they're on the yellow line. And as I said, that's very conservative. It'll probably trade at 120. Now, can you see to the far right, Johann, the most recent 3 years and then right to the far right is also negative. So that actually shows that just from a normal investment perspective, these stocks in that total don't seem that expensive because they haven't been at those high levels where they were before. But let's look at return. So if we take into account that over 3 years and 10 months today, you'd be hard pressed to get 2 at a bank before tax in total. Take 2 there on the left-hand side of the scale and look at what chance you have. You can underperform that 1 or 2, whatever you could have got at the bank, but look at the profit potential. Okay, now people say to me, but there's problems out there, the sales are going to be down, the dividends are going to be down, whatever. I say that's fine. But just taking this 3 year and 10 month history, you can see the average year. Average performance was 7.1 in dollars. That 7.1 would have been net of fees, costs, and expenses. And that, against inflation running overseas now, maybe 1 or 2, gives you a very high real return. And coming back, you onto your objective there of high real return in that longer dated bucket of your equity. But your risk is to only underperform by cash. So your downside is a fraction of the risk of the pure equity.
Just in layman's terms, so basically 72% of the time, over a rolling 3 year and 10 month period, okay, this product would have returned a profit, and 27% of the time it would have returned you your capital, because 27% of the time it would have made a loss. But if you invested in something like China Seas, you get your capital back. You don't take the loss like you would have had you been invested directly in the market. So this is just in layman's terms what this is summarized.
Yeah. So that's
just to confirm, so that average return, the 7.1%, that's in dollars.
It's all in dollars, yeah. Everything's in
US
dollars.
or Australian, because this is Australian.
US. This is all US dollars, yeah. US. Yeah, so that's very important because as you're saying there, Ronaldo, you can then compare that to what can I get at a bank.
But now also what's important now, it takes these highs into account. So if you now enter from here, you know, and we do the same calculation, ignore this over, you know, the next 10, 15 years, then that would be higher, because the entry point that we're going in is very low.
Yeah, but and the other thing is, if you look at, let's just quickly stop for one moment and say, where are we in the world today? We think we're at a place that says the costs for those big companies are going to be very well controlled for the next 4 years. Why? Labor costs, human resource costs, personnel, they'll be very low, because very few people will fight with their boss for an increase or a big bonus when they're struggling to keep their job. Secondly, all the fuel-related costs. I mean, oil, you've seen where oil's trading, okay? And oil used to be $100 a barrel, now it's $32. So the fuel and transportation and logistics costs for all those big companies, very well under control. And then the interest charge. You know, interest rates in Europe are negative. And in the US, they've been cut to nothing. And most of those big corporates have big capex and big operating costs, which they often fund with loans from the bank. And that will be very well contained. And then the other nice one, which is not nice for the grandchildren of the American people or those of the European people, is that they've taken their savings for the agterkleinkinders and they pumped $7 trillion into the system. Okay. Now, just for the shareholder must say, if they've pumped $7 trillion of liquidity into the system, and the costs of these companies are going to be very well under control going forward, and they then find an antidote for the virus, like a vaccine, which they've done every other time in history, what will happen to shares? We think you've got a great chance that they give those big rock and roll type times again. What's horrible then? If you forgot to buy shares, but you were still in cash, or you took your money and you bought a balanced fund. Johann can give us an idea how much of people's monies are in balanced funds. I think half of their money. Now, let me quickly highlight to you. I had a balanced fund manager phone me who runs a big US dollar balanced fund manager. He said, can I buy your China Seas to put into my balanced fund? I said, of course you can. You know, it's got a share price daily. It's got all the numbers, all that. Why would you do that though? He says, because my challenge in a balanced fund today is in dollars. If I get $100 from the customer and the equity markets go up 50%, I'm only giving him the 50% on half the money, because the other half of the money is in the fixed income. So on the fixed income component over 3 years and 10 months, I might be lucky to make 10 on 50. But then I'll make 50% of the 50. I'll make a 25 on that equity component. So in total, the customer will be up 35. He says, in your share, if the market goes up 50, you're giving me 55. Maybe even more. But if it goes up 50 and you got 20% gearing, you'll give me 60. Okay, compared to 30. Secondly, if the market crashes 50, he says if the market crashes 50, I lose half the money on 50% of the assets. I lose 25. I soften that by the 5% I'm making, or maybe 10 if I'm lucky, on the bonds. So the customer's still down 15 or 20, and that's before fees and costs. So, you know, in life you can only be lucky or unlucky. If you're lucky, you must make a lot of money. If you're unlucky, you mustn't lose your money. That's our philosophy. And this demonstrates exactly how that will work.
So just in layman's terms again, Japie, sorry for interrupting. So there can only be one or two outcomes. The index is either going to be up, and then you're going to make money, whatever you've put in times 1.1 as per the prospectus. But like Japie's alluding to, volatilities are low. They might trade higher. So say maybe times 1.2 as a best case scenario. And if the other option is markets are going to be down, in which case you will get your whatever you've invested in dollars, you will get back. And like Japie said, the opportunity cost for you to keep your dollars in cash offshore, you're basically going to get nothing for it. There's 0% interest for placing dollars offshore in a call account or whatever. So yeah, those are the two outcomes. And just as a closing point on this average return of 7.1, if we take US inflation, which was roughly under 2%, but let's call it 2%, it's still a real return of 5. Now, a real return, just for those of you that don't know, is the nominal return less inflation. So if you compare that, to just to a South African perspective, and we run an inflation of, say, on average of 6, that gives you the equivalent of about 11%. So we always look at, what is the real return that I can make on an investment, and how much capital am I putting at risk to make that return? And like we've alluded to on the capital structure of a bank, ordinary shareholders, they put all their capital at risk. They stand the risk of losing everything. So you have to put it in perspective. The type of return that you can make of 7.1 relative to the risk that you're taking is actually it's an exceptional return relative to the risk.
And also, Johann, just do you realize, you see the maximum there was 23% per annum. So it's not, the 7 is just average. And we're thinking that you've got very good prospects of making much more than 7. Because your entry level is low. Yeah.
If you climb in at these levels, it's more, I won't say it's necessarily going to be exactly that, but it's going to be rather north than 7. Yeah.
Okay, let's go forward. So page 13 just shows you...
Japie, can I just quickly stop you? So in terms of the return, I mean, the dollar return is great, and I mean, you've got the downside protection and everything, so it looks like a really nice product. My question is just on the timing, given the rand-dollar exchange rate currently.
Yeah.
What's the impact of that, and is it the best time to take your money actually offshore?
Let's answer
that one, Japie. So, Rolandi, first of all, you will never be able to time currency. So nobody knows exactly what will happen. I can tell you from most companies' views, they feel that the rand is undervalued at the moment, and the rand should strengthen. That's over the short term. But if you take a 20 to 25-year time horizon, then the rand will depreciate. And it's all got to do just with the difference in inflation, which is the purchasing power parity between two countries. So if their inflation is 2 and our inflation is 6, it means that the rand should depreciate at least by 4% per annum. But what we've done, we had a look at the history just to see is, does the rand actually, just depreciate by 4% per annum, or how does the rand behave? And you will see that we went back to 1990, and we did this just because that is where PSG's graph started, and they used June as a starting point. So the rand was actually trading at 2.66 in 1990. So we then looked at in which months did the rand blow out, and the first big blowout was in 2002, and it happened in January. And the others occurred again in January in 2016, and in 2018 it was in September. And apologies for not updating this. I'm actually working from a spare laptop. My laptop crashed yesterday, so I don't have the most up-to-date information. But we can add, what has recently happened up until 2020 into this graph. So the point we're trying to make here is, if you look at it, the rand was trading, 2 rand, 3 rand, went up to 4 rand, and it was sitting in September of 2000 at roughly 850, and then all of a sudden it blew out to 1160, and then it came back later that year, went up again, but you'll see that it actually came back to about 672 about 4 years later, and then it remained fairly stable, but once again, whenever there's an event that happens, it blows out. Here it went from 1363 to 1659. It came back all the way to 12 rand 2 years later, and we all know what happened now. So what we did here was to say is, if you took out money, every year over the last 29 years, what would have been your average? Your average would have been 7.60 rand. If you took out money the last 20 years, your average would have been 9.30. If you took out money over the last 15 years, it would have been 9.72, and so it goes on. The point here is you should take out money every year. So if you have a lump sum, let's call it $1 million to invest today, I won't recommend that you take more than 250,000 out now, because it's impossible for anybody to say what the rand is going to do. But if you just have a look at this, most people haven't taken money out every year over the last 29 years. So if you just took out money every year over the last 5 years, okay, and we need to update this to 2020 now, your average would have been 13.84. Now, I know there's a lot of people on this call that, when the rand was sitting at 14 rand, they didn't want to take money out because they were waiting for it to go back to 13.50. Currently, we're at 17.50. So it's never a good time. But what you should look at is what are the growth opportunities. So if I look at rands and you look at the top 40, you must take a view as to what do you think the top 40 will grow by over the next 3 years and 10 months versus what do you think the ESG shares will grow by over the next 3 years and 10 months. And let's just say even if the rand is overvalued at 17.50 and it falls back to 16.50, it's roughly 11% that you're going to lose as far as currency is concerned in rands. But I think the probability for the ESG shares to deliver a return in excess of 11%, is a much greater probability. So you can't only look at the rand. And once again, when you take money offshore, then you need to start counting in hard currency. You can't always convert back. But if we now take a view forward of, say, the next 20 years, what you want to do is take money out every year so that you get the average. And I can assure you, you will be happy with the average rate that you would have got if you take money out over the next 20 years every year.
Yeah, we'll also come to the forward market in a moment. We'll show you that as to what the market is discounting going forward.
Johann, I just want to point out something to you, and I know what Rolandi's concerns are. If you look at that spreadsheet of yours, those must be average exchange rates for the year, whatever, because I know specifically I was on the market in 2008. The rand blew way over 8 rand to the dollar, way over. So if you had to convert your money from rands to dollars in that short period, it was a few weeks. I know, and I can tell you it was between September and November of 2008. The rand blew out to, I think, 15 rand. So if you in that spike period, I think that's what Rolandi's concern is. If she feels we are experiencing one of those spikes now, where we will only see a 17 or 18 rand to the dollar in 2-3 years' time, it's fine because you would then make the same. But it could be, if you're very positive about Ramaphosa on the farms and all these things, then the rand could go back to, in 3 years' time, we might sit with a 14 rand. Possible. I think that's a risk you're going to run in this, but I'll be prepared to take my bets against the rand.
Yeah.
Just to clarify, so what we did here is we took the Reserve Bank figures for January, June, and September, and then we averaged those three numbers. Just to get an average for the year. But there was quite a lot of data to download. Carly actually had to do that. It took her a while just to get these figures. But what we can do, Carly Annalay, for future projects is maybe go and pull, all the months in between so that we get the 12-month average, like Steve is alluding to there. And then we can update it and we can forward it to everybody. But I think that the point is just... Steve, you're never going to be able to time it. So it's better to take money out every year. And in 20 years' time, I'm sure the average will be, acceptable.
I think if I can come in, Steve, I'm pleased to see you there. From when Steve and I were at university together 39 years ago, I used to bring my money in from Zimbabwe at one rand to $1. And today it's 17.50. Just putting the long term into perspective. That's how long ago him and I were naughty at university together. Yeah,
but I think, Japie, what happens here, one tends to, because you look at this product with a term of 3 years and 10 months, you try to predict the rand there, but one shouldn't, the point I was trying to make, you shouldn't look at it like that. If you've got rand assets, let's say this is an investment, but you've got a lot of other rand-based assets in South Africa.
Yeah.
If the rand bounces back to 13 or 12 rand in 3 years' time and you didn't have the kind of return you expected from this product, you must say thank you very much, because all your other assets in international terms would have appreciated in value. It's a balance of all your total asset portfolio. I think that's how you
absolutely. But
I concur with that.
Johann, let's go forward on that because we're going to come to this point now, bringing up these points in a second when we come to the long term of these graphs. Just hold on to that page 13 for a minute. I just want to highlight to you the value of this protective nature of these shares. Now, we had a summary, Johann, you've got the other one-page summary from when we started this business, maybe just this page. Yeah, just hold on to this page. So I mentioned to you that we're now managing just on 20 billion. But if you look to the left top here, just this principle which we're applying in this investment type, we've done now 129 listings over a 20-year period. 70 have matured. Of the 70, only 3 we returned the capital only to the customer. The other 67 or 94% of them were profitable. Okay? And that's a very important statistic because what we're going to come to now, as Steve is saying, is if you've just got dollars, whenever you take them out, but you just make sure you never lose any of them, then in a continuously sliding rand over time, that becomes a very valuable asset. The hard currency, as I say, if you build up a nest egg, make sure that when you get there, the eggs are still there. They're not half broken. Then it's no longer called a nest egg. Okay. Johann, let's go back to the main presentation. This is one of the 3 where we only gave their clients their money back. And it was launched, this is an MSCI World, and it was launched in the period from March 07 through to September 10. 5.5 years. If you'd been in the MSCI World, you would have lost. Our investors on our share would have lost 44%. If they added their dividends back, they would have lost 38%. In the share that they bought from us, they lost nothing. They had the advantage of just going and getting their £100 back, and they were able to buy the market at this depressed level and save that permanent saving. The loss that they didn't incur. That is absolutely important when you look at compounding. If you can avoid, so that's why a lot of people have turned away from saying, I always just used to buy and hold. Because I say, if you can buy, but if it's a nightmare, don't hold at the market price. Walk away from the problem with your capital intact. And that just shows that. Let's go forward, Johann. There's 2 or 3 more slides, and then we've wrapped this up. Okay, just as to the volatility of late, that just shows you an indication when the markets crash, how the volatility spikes up. And the volatilities have come down now because as we've seen there, markets have recovered somewhat. What I want to demonstrate here is we've got a lot of clients who say, but you know what, I'll just go buy an exchange traded fund, which is the market, the ETF. The problem is if you buy an exchange traded fund, but you don't want to take downside risk, and today's numbers, like you buy car insurance, household insurance, medical aid, those are put options. They protect you. It would cost you roughly 16% for a 3-year and 10 months. That would mean you'd only get 84% of the upside. If you did it at home on Charles Schwab on your own computer at home, without involving Johann or us. Here, by using the Standard Bank credit inside the solution, we beef that up to 110 and probably 120. So that's the benefit of the structure. Let's move forward. Okay, here's a very important one as to this offering right now. This shows you the 120-year average in US dollars of the different asset classes. Shares, 9.6, and in real terms, 6.5. So US inflation average over 120 years was just on 3%. It's lower today, but that's historic average. Bonds used to give 4.9 and 3.7, but at the moment, bonds give very little and cash nothing. That's why we're confident that looking forward over the next 3 years and 10 months, most of the flows in the world will go to shares because the alternative of bonds and cash is too poor. Okay, that's why we're saying to you as a prospective investor, you got to pile in and have a lot of money, especially if you're going to have 110 or 120% geared exposure to the upside. Then that 2% on the dividend versus the decrement is just noise. It's not going to have a big impact because what you want to try and do is get the long-term average or better because your timing is good, but then with a geared upside. with the protection on the downside in place. So that's important for the long term. Then page 16 just talks to, this is an important graph, and it comes to your question, Rolando, from just now about the currency. This is one of our shares, the second one we ever started. That started in November 2004 at £1,000. And the rand was 11 rand 16 to a pound. 5 years later, remember now when it gets to maturity, the bond pays out the capital of 100 and the options pay out whatever the equity market did. These investors can roll, they can go for another phase. Importantly, if you keep a share, Steve will tell you, you don't trigger tax when you keep an asset. You only trigger tax a share when you sell the share. So the beauty here is you lock in all your profits. You deleverage all your risk. You take your risk out because the capital guarantees now at this new high watermark. 5 years later, we locked in at 1733. 5 years later, we locked in at 1947. And I looked this morning, Johann, that share's now bounced from 1861 where it is now, because it went up last year, came down, and as of this morning, it's back to 1961. So it's on the way back, bounced up. These investors, when they last rolled, we told them we'd have a 5% minimum by November 2023 and a maximum of 2920. So we don't have 1 cent of shares in stock. Why? Because the shareholders protected. They know that even if the market's going down, don't stress, don't panic, just hang in. If you had the live portfolio and you were down here, you might fear that it goes back to 1200. So what do people do? Then they sell. They sell at the wrong time because they've got nothing protecting them. Okay. And if it so happened, heaven forbid, that the market went down back to 1200 by November 23, what will our shareholders do? They'll press the undo button, cash in the 2044, and be able to buy the market at 1200. Okay, so this thing is very powerful because what it does, it gives you the benefit of being able to roll on with no capital gains tax. So you got no loss of capital and no interest pay away. And I mean, we all know, and Steve, your whole business is premised on that, how much tax people pay. And to save tax or to manage tax is good. So what happens in the Guernsey company? That 80 that grows to 100 is with zero tax. It costs me in total for the whole company £2,000 a year to exempt it from any tax, 100% legitimately and by law. Okay, so look at the shareholder here. If they sell the shares, let's say they sold the shares in November last year when they rolled at 1947. Because it's a foreign share, you got a big advantage. You only pay tax on the profit in the foreign currency. Bought it at £1,000, sold at 1,947, you pay tax on 94%. And you can pay tax either at the final exchange rate, which was 22.30, or the average for the last 12 months. If you think about it, you take the SARS website and you go for the last index currency level, for each month. Let's say that was 20. So if it was 20 average, you would pay tax on 195. But if you look at your rand profit, it's gone from 11 to 41. So if you were paying tax like you would pay tax on Richemont and brewery shares and Sasol or any foreign company listed in South Africa, you'd pay a lot of CGT. So the beauty here is you can kick the tin down the street and you can have your grandchildren pay the tax. Just don't sell the shares.
Recap that in layman's terms. So on the initial 1,000 that you've put in, the currency depreciation on that 1,000 from 11.16 to 22, you're going to pay zero tax on. You're only going to pay tax on the 947 hard currency growth, converted back to the average. The average Japie took at 20.
Yeah, so, of the last year, the average of the last year only. You take the SARS website and you can select. So if you think about it, that's not very clever from the tax department, because if the rand's strengthening and you sell, you take the last value. If the rand's weakening, you take the average.
Yeah, but we'll thank them for that, Japie. Don't put the
don't tell them
it too much.
No, this is just a simple
status quo.
That's just us Zimbabwe farmers noting that, but it's not for consumption by the wrong people, hey? Okay, but that's a very powerful graph, and that's what you're trying to do here. You're trying to build long-term capital. Remember, the portion of the money that Johann said this was part of is your long-term capital growth. And it does that because it protects the capital and it locks in your profits. If you bought unit trusts only or shares only or ETFs only, you never lock in the profit. Rolandi, coming to your question about the rand, this is just what the rand dollar forward is showing. Roughly 29% devaluation expected. That's not Investec's view. That's you go into Absa, First Rand, Standard Bank, any bank, and you want to take out forward exchange cover. That's the rate you can take out the forward exchange cover. It's not...
But they only work on inflation differentials, like I said earlier.
Yeah.
I mean, this doesn't take into account, that the rand is undervalued from the starting point. They just take the starting point at where it is and extrapolate it forward. But I think we all concur that it should be closer to 1650 or somewhere there.
Yeah, I'd also say that.
14, but the trend, even from 16, if you make your starting point 16 was somewhere over here, it'll
still be 29. Yeah, it'll still be roughly 29, whatever starting point you make it. Look, this isn't saying that's going to happen.
On the exchange rate, we've still got, I think what's the last date to invest is it somewhere in July?
The 10th of July.
10th of July.
So we've still got a month or so, to check the currency. If you sit on rands, which you need to convert, if you're not sitting on the dollars, you still need to convert.
Absolutely.
So one can still, you've got a month to play.
Yeah, you got time before you have to take a decision. Yeah.
But like I said in the beginning, this is probably 75% more aimed at money that you already have offshore, either in cash or in balance type funds.
Yeah.
Because then you don't have the currency risk of converting now when the rand is weak. But yeah, I just wanted to mention that.
Okay. So the next input then, so the fees and costs, we don't need to cover. The fees and costs are all built into the pricing. And Johann, you don't charge upfront charges, if I recall.
No.
Okay. No. So let's consolidate our thinking and say, why is it that this product range has become so popular? Firstly, once you've bought, you get a daily price. It's daily liquid. There's a fact sheet which shows you monthly exactly what the performance has been. So it's fully transparent. The other thing that people like is that you don't have to put that capital at risk. You want to just go back one page to that high level summary that you had a moment ago, our long-term summary.
This one?
No, not that one, the other one, the one pager.
Yeah.
Just stop there, just hold it there. What I can mention to you is that here under the awards section, in what you used to unit trust is Raging Bulls. Raging Bulls is the people that analyze who's done the best under balanced funds, and just hold it there, or equity funds or whatever. In the category of structured products and derivatives, this category of assets, there is no South African measure like that. So the guys who measure this is SRP. SRP is a full subsidiary of Euromoney. And just on that page there. And they have, this team that designs these things, we've won the award. It's only existed for 4 years. They've had a category for Africa. And we've won the award, international award, for 4 years in a row as the best bank in the world doing structured products and derivatives distribution into Africa. So, growing a business from nothing to 22 billion and not having one where a client lost ever in 20 years. Has also come with the independent best in the world breed, checking all the banks and nominating and awarding us as the best bank that does this. So I think that it's been tried and tested. This is what I buy with my money, and not for all my money. I would put into China Seas, for instance, what I'm happy to have put into a share in Standard Bank or a preference share because I rank ahead of them. So that's the other thing, and obviously, what you have here is you've got fantastic big companies that you can support. That's for a good cause, but not to your financial decrement. Not to your loss of income, because they're just as good as the next big international company. But I've spoken a lot now. Let's see what questions would arise.
Okay, Japie. That debt instrument from Standard Bank.
Yes.
Is that the debt instrument you take out specifically that's just for this product? It's not something you buy on the market. Is it a debt instrument which Standard Bank issues specifically for China for this product?
No. So what happened? Standard Bank issued a $400 million debt instrument. The quantum is 400 million, and we've bought 80 million. We've bought like 20% of it to put into our Guernsey company.
Okay.
So the other people that hold it, the other people, Steve, that hold the debt is mostly your Coronation and Alan Gray and your big fund managers.
In their bond and money market funds. And
and in those high income funds, those high income funds.
Yes. Now, why did you decide on a South African bank instrument? Is it just to get the higher yield?
Yeah, we're getting about 6% on this debt, 6.1. If you use Citibank or Goldman Sachs or whatever, you'd get 2.
Yes.
You can't do the deal.
Yeah, I understand. Yeah, because you haven't got that margin which the yield gives you. Okay.
Exactly.
Yes. So just to go back to your example of the farm.
Yeah.
So what happens is that if we are protected if the drought comes, but if the opposition comes and they burn down the whole country with a farm, and the whole lot is gone, okay?
Yeah.
Then we're in trouble. Is that what you're saying?
Unless ABSA doesn't go down because the farm's going down. Because remember, our capital is at ABSA.
Yeah, what I'm saying is they burn down the whole country with a farm.
Oh, yeah, look.
Okay.
That could happen, and I think that's very important.
That's the ultimate risk, yeah.
Exactly.
Exposed to a South African bank.
Yeah, exactly, Steve. So what happens is that you got to say, but let me mention to you, you got daily price and daily liquidity on the share. Okay? Yes. So let's just take any share that you've bought in the past on this. You can see the daily price there. There you've got Investec risk. For whatever reason, you think I'm not happy with that risk anymore, either for sovereign reasons or the bank's reasons or whatever reason, you sell your share. You got daily liquidity on the share.
Yes.
So just important to mention there that the 100% capital guarantee is only if you hold it to maturity. So yes, you have daily liquidity during the term.
Yeah.
But you won't necessarily be able to sell it, at minimum what you've put in.
No, it will come at a discount,
It will come at a discount.
Yeah. But the thing is, you can get out. That's what's important. And also on that, Johann, because your equity upside, remember the options are bought on 40 international stocks, nothing to do with South Africa. Sold to us by Goldman Sachs, got nothing to do with South Africa. That asset is totally independent of South Africa.
Yes.
So if the world's going on all right and shares are going well, that thing will take off like a rocket, and that's an asset inside the company which is not affected by Standard Bank or any bank for that matter. They're independent of each other.
Are those options American options or European options?
Very good question. They're European options, but we get a daily price from from Goldman Sachs. So let me pick up that, Rolani. What happens? We buy them for a 15, we spend 15, and contractually we have a bid offer spread of 0.5% agreed with Goldman Sachs, and they give us a daily price. So if markets are rising, they have to reprice, and that's what is in the fact sheet. Johann can send you what a fact sheet looks like. They reprice minute for minute, day for day, but the payout's only on the final calc at the end. Here's, for instance, if we have a look, take the Titans, take any one of them. Probably take Titans as an example. That's a good way to look at it. We'll just show you a fact sheet of one of the companies. So this is very powerful. Just page down, Johann. So just on the cash flow, just make it a bit smaller. So in this deal, in October 2010, we bought from UBS, just hold it there. We bought from UBS for 191. You can see the cash flow for the option was 191 of the 1202. So roughly 16%. That was the amount of that on that deal because it was 5-year. And the indices have gone up 21%, the MSCI World in this example. And you see the price of the option is 328. You want just page down, just keep it there, keep it there. That 191's gone to 328. It reprices every day. But if you go to the far right, Johann, just move it a bit more, to that number, because we can't see it. It's behind Annelie on the picture.
Okay, sorry. There, can you see it now?
I can't.
So make it a little bit smaller. Can you see it now?
Yeah, there. It's 402. So how it works, in this deal, the investor had a 200 gearing, but only from 5 positive up to a cap of 30.9. It was a different structure. But suffice to say that the profit there was 33%, and the 33 on the 1202 would give you 402. That's why Johann mentioned that your profit is on the total capital up front.
Maybe just if I can add something here. So this is the inception at the status quo at inception, right? Let's just assume this is now July 2020. So Japie is going to put the 80 down on the bond, and it's going to accrue interest at 6.1, and it's going to mature back at 100.
Yeah.
So your 80 becomes 100. So that's why he's saying your capital is guaranteed. But this equity option, if the market goes up, it's up. If the market goes down, it decreases. But the bond always steadily increases. The bond doesn't go up and down. It just steadily increases. So, if you take the value of the bond plus the value of the call option plus whatever cash is still sitting in the bank. Remember, they make provision for the fees over 5 years, but they don't pay out, all the fees in year one. So there are still some cash in the bank. If you add those together, you get the share price. There were some examples, when we looked at that when markets tumbled in 2008. The value of the equity option will never fall to zero because there's always still time left, and the value of an option, gets higher the closer it becomes to the end of the term. Yeah, that's all I wanted to add.
That's a good example, Johann. Yeah, so very good question, Rolanda. It's written as a European, but to give it liquidity, you force the counterparty bank to give you a daily price with a 0.5% bid offer. So just keep it there. If UBS made a mistake and they try and tell us on this date, which was the last month's end, that thing's only worth 250. I'm just using an example. We contact them and say, guys, per our contract with you, you're supposed to give us the daily price and you're allowed to take 0.5% off to make it, Steve, the net realizable value. Now they say, no, we're happy with our 250. We say, fine, we'll order $100 million from you at 250. And we sell it 1 minute later to Bank of America for 3.
Is like the price of a can of Coke. If you walk into the Sasol, you know more or less what it will cost. If you walk into the Spar, you'll know more or less what it will cost. And the difference, between what UBS can say the option is worth, Investec and everybody else, they've got their own programs and systems and algorithms. So all he's trying to say is that they can't cheat us with what the market value of the option is. They know exactly what it should be worth. And Japie, just for clarification, you've never had an instance over the last 20 years, where such an event has occurred, where the option provider didn't provide an accurate price.
No, never. No, when they meet us, they understand that we know how it works. And we've got all the pricing models, and we tell them if they're 10 cents out on the price. Okay.
Yeah, I just asked the question to understand whether you have the opportunity to actively manage that option,
yes.
Whether you have to sit and wait the time out.
Yeah, so what's important as well is that we don't change anything during the term. It's a totally passive investment. So on day one, we put the bond, the cash down for the bond. We sign the option contract and give them the cash. And for 3 years and 10 months, we don't move a finger. We never buy a share. We never sell a share. We never go cross currency, doubles, and incur costs and fees and churn, nothing, naught. And these assets, just hold it there. Can you see what the big advantage is? And this is what Steve will highlight to you, is the fact that the 919 grows to the full value with no income tax deduction. Okay, it's a beautiful, income statement. It's got no line for tax.
Let's just explain that again in layman's terms, Rolandi. So if you were to buy, not that you can buy that bond, but let's say you were able to buy the bond, which attracts 6.1% interest, and you held that in your own name, you would have had to pay income tax on that 6.1% yield.
At 45%, yeah.
At 45%. But the Guernsey company, there's no corporate tax in Guernsey. So there's no interest payable on that yield that they're getting on the bond.
So just taking that a bit further, so just in this company that we're looking at, can you see that 919 growing to 126 is probably about $300, zero tax. In this example, the 191 growing to 400, that 200, zero tax. Now we get to maturity, we say to you, Yurandi, would you want to keep your shares? They're now worth 1665. You say, I want to keep it. Then we roll it at 1665, and 1665 becomes the new 1202. Same
it
story.
becomes your new capital guarantee, because this is now the value that the new shareholders must pay to get into the company.
Yeah.
And remember now, 80% of this is going to be placed on a deposit this time around with Standard Bank, the bond. So you can reset your capital guarantee over the term. This one was done over a 5-year term. The new one that we're doing is 3.3 years and 11 months.
So you want this page?
Sorry, that when you decide to roll over, you're not triggering a capital event at that point.
No.
You resetting your minimum base, but you're not triggering a tax event.
That's very important. So for tax
that's the
purposes,
only investment. Sorry, Japie. I mean, that's the only investment where you can do that. If you want to take some profit on a listed share, you have to sell the share. If you sell the share, you trigger a tax event. The same applies to a unit trust. You get roll-up funds, which do not make any distributions, which are also tax-friendly. But the moment you want to, access those gains or lock in those gains, you have to sell. So this is, it's a unique
I think that's what I like about this one.
Yeah. You see, that is absolutely unique. We don't know of any other asset that can do that for you, because remember, this big tax advantage means you don't have to put this into an endowment or a wrapper necessarily. That's your choice. Also, what it means
I don't recommend it, Japie. Just on that point, I don't recommend putting this in endowment structures, because the tax functionality is already built in here. The only reason you go to an endowment is to pay less tax. So if you take an individual as an example, let's assume you're on a marginal rate of 45% times the inclusion rate of 40%, you're going to pay 18% capital gains tax. If you go to an endowment, you're going to take the life company's tax rate, which is 30%, times the 40% inclusion rate of 40%, that gives you 10%. So there's a saving of 8%, but that's only on the profit. What the endowments do is they charge you an administration fee based on your total assets under management. So, you always have to do a calculation in terms of, does the costs really justify the benefits? So there are other benefits of investing in an endowment, from an estate duty perspective but it's not necessary to have those benefits if you're in a tax haven like Guernsey, because Guernsey do not have estate duty, so there's no benefit from an estate duty point of view. From an executive fee point of view, yes, you will have to appoint an executive to wound up your estate offshore. And in an endowment, you can transfer it to a beneficiary without going through an estate. But those are once-off savings. Nobody knows when you're going to die. But most of my clients prefer paying tax when they're dead as opposed to paying tax whilst they're alive. So
that's because the tax you've got to pay it.
You have to do calculations. What's the status quo whilst I'm alive, and what's the status quo once I die?
Johann, Can I ask you, just to show the audience, just page down to the Aussie dollar in the same share, just page down till we get to the Aussie dollar. Just stop there. Just for your purposes, in the first phase of Titans, this company, it started in March 2011 at 1,000 Aussie dollars. It rolled at 1579. Can you see that 1579? This is the second phase. So our investors in this company is worth 2.4 billion rand. They now worth 2,227 Aussie dollars per share. So those legacy share class who had them in Aussie dollars have grown from 1,000 Aussie dollars to 2,227. In other words, 122% in 8 years. And Aussie inflation is 1.5 a year. Okay, we don't have anybody complaining. They all quite happy. Okay, and they haven't paid a cent of tax in 8 years. And until they sell their shares one day, they won't pay a cent of tax. Because Steve will tell you, only detection risk in tax is when you've actually done a crystallization, when you sold the asset. When you keep the asset, you haven't got the cash in your bank account. He can't tax you. He can't assert that you've got anything.
Any other questions? Yeah, please feel free to ask as many questions possible.
Yeah, Japie, other than the environmental issue, is there any investment reasons why you picked the environment index?
No, we just felt, Steve, if you look at this share, just page up, Johan, just page up some more, you'll see this one is on the MSCI World Index. Yes. And what Investec has said, because we've got this Credit Suisse report, which I'd actually like Johann to forward on to all of you, is where we can show that there's no real loss of return by supporting the environmental theme. You don't lose on return. Then the issue is, why don't we afford our investors nationally and internationally an opportunity to support a good cause? Because there's no loss of profit to that investor. Do you understand?
To the contrary, Japie, I think there's actually going to be an increase in the amount of fund managers globally that's going to invest in these ESG shares. I think, if Corona is taught us anything, is, that we should start paying more attention to the environment. So I think, and that was on that first slide that you showed with the flows. Which one was it now?
Just one more.
This one.
That one. Yeah.
So the inflows in 2019. I can guarantee you 2020 and 2021 is only going to be higher. I've got some reports from Goldman Sachs, Bloomberg, Japie Morgan, and I can forward it on to you with their views on these ESG shares, and they're all very, very bullish on them.
But I think, coming to the exact point, Steve, we just say, and I say it because I put my money into this, if I can help make it a better world without it costing me return, then that's what I'll do as a good citizen. I'd like to help, as long as it doesn't cost me return, eh?
Okay. That makes sense. No.
Because you see what happens, we say to investors, look, another part of your money, the guys will pick any stocks, and those might be good or bad, they could be, but they've got a different return profile. We just don't want to be doing this if it's going to cost our investor profit return. Yeah, this is the existing one, but I don't think much turns on this one, Johan. Just because it's...
Yeah, no, I just want to point out here that this is the existing one, and those were the indices that they were in previously. And you can see the weighted movement is only up 7.83, but the previous one had a participation factor of 200%. So,
and with a cap at 22.6. So when the markets were high in the past, we were doing them with a 200 or 240 gearing, but we put a cap on it. What's happened now, because the markets are low, if you look at that graph where we showed the 3-year and 10-month, it's negative now, and they've pumped $7 trillion of liquidity into the system. What I want as an investor is I want to make a lot of money, and I don't want to be limited to with a cap. At the moment, we think it's better without a cap. Because remember, when we launched this, there wasn't a 7 trillion liquidity in the system.
And the other point is,
maybe for those reasons, I'm just looking at the list of these companies. It's heavy laden, this index at this stage, with financials. It's all banks and insurance companies that makes up nearly half the list. So, it's a lot of banks.
Keep in mind that they basically every year there will be new companies coming in and some falling out. If Airbus is also in there, somebody asked me the question. You don't really want exposure to any airline.
No, Boeing. I see, for instance, Boeing is in there.
Boeing, but still, it's not necessary to say in 3 years, in 10 months' time, you're going to own the shares that you see there now.
Yeah. That's dynamic. But also the thing, Steve, about it is, remember, each one of these companies only is 2.5%. They're equally weighted amongst 40.
Yes.
So what you're doing here is this is not your alpha generating fund. You've got another part of your money where you give your money to a fund manager and you discuss with him the shares he's buying. That's a different part of your capital. This is not that part. This is the part where you're saying it's also not for everybody. It's only for people who want to eat well and sleep well. Okay. You just don't want to lose money. That's the simple thing here. But you want to make a lot of money.
You're not going to lose money, but you would like the project. In 3 years and 10 months, at least you would like this index to be up.
Yeah, 100%. And I think that's why we did that 3 year and 10 month rolling return to show you, a simulation, so you can see what type of money can come out of it, especially against nothing at the bank account or very little on bonds.
Yes.
Just to add what Japie is saying is there. So we're definitely not saying that this is for all your money. Remember, there are unit trust listed shares and ETFs that a portion of your money should be exposed to. But this has a place in the investment portfolio, for a portion of your funds. And that's why I won't recommend. I will obviously sit with each and everybody that want to invest individually and give you my take in terms of what I think you should be putting in here. But you also put a prudential limit on Standard Bank. You can't expose 100% of your capital credit risk wise to one entity. Yeah. So there are various factors that you have to take into account. But if we look at the construction of a portfolio, it forms part of your creation strategy. And under foreign equity, let's take the previous slide of unit trust listed shares and ETFs. All four of those are in foreign equity. So this is just one of the four components of foreign equity.
Yeah, just hold that if you don't mind, Johann. Just to summarize in one sentence what this product range is trying to do. It's trying to say if there's a crash, then you add cash. Because cash is better than a crash. Right. First point. Second point is if there's a bull market, then you add wealth creation assets because you had 110 or 120 gearing to the best asset class and you added for 100% of your money. You didn't have half of it in fixed income and bonds because your 15% call is on the 100.
Yeah.
So for the reward you can make against the risk you're busy taking, it's improved your ratio. And if you go to investments, obviously they refer to that as the Sharpe ratio. So you can say it's very sharp. Okay. Good. Any other questions?
No, I'm done. Thanks.
Okay. Anil? Nothing? Rolandi? Anything else there? Johann, if we missed something?
No, I think we're good, Japie.
Okay, guys. Thanks for your time.
Thanks, everybody. Thanks for tuning in.
Thank you.
I'll save this presentation on YouTube as well for those of you that want to go and listen and miss something here and there. That you can listen to whatever we've discussed, but you're also welcome to contact me. If you want any further information.
Yeah, it's got lots of time. We are fortunate to be early because it only closes 10 July.
Yeah, there's still lots of time. Have a good weekend.